Hello, I am Christopher from Paramour Forex Trader Team. Today is February 7th. I want to talk about Forex news and what you need to know on Wednesday. The FX galaxy seems to have entered a broad-based consolidative phase against the backdrop of rising speculations that major central banks, with the exception of the BOJ, might now take more time to assess the start of the easing cycle. The corrective move in the greenback prompted the USD index, DXY, to abandon the area of recent yearly highs around 104.60 amidst an equally weak tone in U.S. yields. Balance of trade figures and a slew of Fed speakers are next on tap on February 7th, Kugler, Collins, Barkin, and Bowman. Euro to US dollar traded within the familiar range and close to the area of the 2024 low near 1.0720, remaining unable to capitalize on the renewed selling bias in the greenback. Industrial production results in Germany will be the sole release on Wednesday. Pound sterling to US dollar rose markedly and managed to leave behind part of the recent two-day deep retracement, regaining at the same time the area beyond the key 200-day SMA. Across the channel, Bo Breeden and Woods are due to speak along with the release of the Halifax House Price Index. US dollar to Japanese yen broke below the 144.00 support and dropped to two-day lows on the back of the marked downward bias in the greenback coupled with renewed demand for US bonds. In Japan, preliminary readings of the coincident index and the leading economic index are due on February 7th. Australian dollar to US dollar regained some balance and printed marked gains after two daily drops in a row, all in response to the sell-off in the dollar while market participants kept digesting the RBA's hawkish hold. In Canada, balance of trade results are due on Wednesday, followed by the BOC summary of deliberations. US dollar to Canadian dollar partially eroded its recent two-day advance following the weak dollar, while BOC's T. Macklem asserted that additional time is required for monetary policy to alleviate lingering price pressures. Prices of WTI added to Monday's gains and flirted with the 55-day SMA around $73.60 following news that U.S. crude oil production could come short of expectations in 2024. Prices of both gold and silver advanced on Tuesday in response to the poor performance around the greenback, declining yields in the global markets, and a mixed tone in the commodity complex. Gold price forecast, XAU/UD rises on the back of falling U.S. Treasury yields, weaker USD. The XAU/USD currently stands at $2,035 up by 0.52%. Bulls show signs of recovery after two sessions of losses favored by a weaker U.S. dollar. On the hourly chart, indicator readings are pausing their advance to consolidate gains. Bulls still control the daily chart as buyers recovered the 20-day SMA. In Tuesday's session, the XAU/USD surged to $2,035, reaffirming its bullish scenario in the daily chart. Despite central banks evading sooner rate cuts, bulls still show dominance favored by lower U.S. Treasury yields, often seen as the cost of holding non-yielding metals. On the hourly outlook seems under strain as investors consolidate gains, leading to a loss in momentum as indicated by weakened technical indicators. Looking at the signals on the daily chart, the bull's strength prevails. This bullish sentiment is supported by the positive upslope of the Relative Strength Index, RSI, and the increasing green histogram bars of the Moving Average Convergence Divergence, MACD, both suggesting a strong buying momentum. Besides, the price is trading above its 20, 100, 200-day simple moving averages, SMAs, underlining the dominance of buyers in the longer-term trend. In addition, as long as the buyers manage to hold above the 20-day average, the outlook will still be positive for the short term. Shifting focus to the hourly chart, the momentum seems to show some exhaustion as investors start to consolidate their gains. This indicates that in case no fundamental stimulus arises, the price may continue trading flat ahead of Wednesday's Asian session. If you like this type of analyses, please subscribe us.